Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us here at AusBiz. Let's take a look at how we're set up from what happened overnight. Global stocks edging higher as investors' concerns over tariffs receded, while a rate cut from the Bank of England boosted sentiment. On Wall Street, the S&P 500 and Nasdaq rose as investors sifted through some of those earnings reports, while also awaiting tomorrow's jobs report. Stocks, specifically Amazon, rose ahead of its quarterly earnings report, which was released after the bell. It topped analyst estimates for quarterly revenue as strong sales over the holiday shopping season boosted its retail business, helping offset weakness in its cloud computing unit, which did see a 19% rise in revenue, falling slightly short of estimates. Shares of the company falling around 2% in extended trade. Qualcomm fell as the chip designer said its patent licensing business would not see sales growth this year after an agreement with Huawei expired. Ford dropped after the carmaker forecast up to $5.5 billion in losses in its EV operations this year. Eli Lilly rose as forecast annual profit above estimates, while shares in fashion house Tapestry jumped on an annual sales and profit forecast increase. Philip Morris shares, they also surged after the cigarette maker posted better than expected quarterly results and forecast 2025 profit above estimates. And Honeywell fell after the industrial and aerospace giant said it would split into 3 independently listed companies and forecast downbeat sales. Well, the Bank of England has cut its policy rate by 25 basis points to 4.5%, as widely expected. BOE Governor Andrew Bailey signalling that it will be taking a gradual and careful approach to cuts as domestic inflation pressures remain elevated, saying we will have to judge meeting by meeting how far and how fast. And the BOE said economic growth is likely to have contracted 0.1% in the December quarter, and it's halved its growth forecast for this year to just 0.75%, reflecting weak business and consumer sentiment and more sluggish productivity growth. In the US, unit labour costs in the fourth quarter rose a less than expected 3%, and weekly initial jobless claims slightly higher than the previous week. US Treasury yields mostly higher except the longer end of the curve. The 10-year is around 4.43%, the 2-year at 4.21%. And the US dollar index slightly higher, while a dovish cut from the Bank of England sent the pound lower across the board. And the yen touching an 8-week high against the greenback after a Bank of Japan Policy Board member advocated continued interest rate hikes. The Aussie at 62.8 US cents. And Bitcoin trading around 96,500 US dollars. In commodities, oil prices settling lower after President Donald Trump repeated a pledge to raise US oil production. Brent crude futures, they fell about 0.4% at $74 a barrel. Copper up around 1/3%, while iron ore has surged close to 2.5% to $106 US dollars a tonne following China's New Year holiday. And gold has fallen as investors took profits from its recent record run. Spot gold down around 1/3% at $2,855 an ounce. All right, let's get more on US markets and the outlook. We are joined by Dave Sekera, who is the Chief Market Strategist in the US for Morningstar. Dave, great to have you back on AusBiz. Good to see you again. Let's get Let's get into what we're seeing, and plenty to get across news-wise, not the least those utterances from Donald Trump. Let's start there then. The effect, his stance on tariffs, his implementation. It has given a couple of countries a reprieve, of course. What effect has that had on markets as you see it?
Well, like anything else, I think one of the hardest things to do in investing is learn how to separate, noise from signal. And in this case, I think we're hearing a lot of noise, but we're not necessarily really seeing what that signal is just yet. And like anything else, with President Trump, I think what you really need to do is focus on what he does as opposed to what he says. So in this case, we're not speculating on what's going to be the ultimate outcome. We're still focused on the individual fundamentals of the companies and the sectors that we cover. year. So for now, we have the 30-day reprieve for the tariffs on Canada and Mexico. But in my opinion, I highly doubt this is over. I think 3 weeks from now, we'll probably be right back in the same situation. So the most adversely affected companies at that point will probably be the Canadian oil producers, some of the cross-border industrials, specifically, U.S. producers like, GM and Ford. And then with the tariffs in China, to me, I think this is just the opening salvo at this point. We're seeing, the U.S., we're seeing China, each side right now is positioning themselves. They're both flexing their muscles. So we'll see, where this ends up going over the next couple of weeks. So for example, China recently announced an antitrust probe into Alphabet. In our view, we don't think there's really any substance there. We think that's more likely than not just another negotiation tactic for tariff discussions. But like anything else, that just may end up, putting President Trump in at least a self-perceived, corner where maybe he's even more likely to try and defend U.S. companies. So really, we're just trying to get much better understanding of what exactly the concessions are that the Trump administration will be looking for. And then we can start really figuring out, how to be able to include that, into our fair values and into our estimates.
Now, Dave, prior to those announcements on tariffs from Donald Trump the week before, it was all about AI with the emergence of China's DeepSeek, raising questions for investors of just how much CapEx is being spent on that infrastructure build around AI. How did you see that play out and the potential effect, with questions remaining, I guess, as to whether DeepSeek really is living up to its claims?
Exactly. There's a lot of questions as far as what its real capabilities and its real costs are, and exactly, what powers its AI, in the background. But more importantly, I think that what we saw here is the market action in the US really illustrates what we highlighted in our 2025 outlook. And what we're looking at, I think this is the year that investing is really going to start to evolve into looking for those companies that can utilize AI to help them drive their revenue, either enhancing existing product and services, looking to develop new and novel, products and services, drive revenue, but also at the same point in time, you'll look where they can include AI in their own business practices, drive efficiency, and start being able to gain, some higher margins. So when the DeepSeek news came out, originally the stocks that sold off the most were those hardware companies, the GPUs, the networking and so forth, some of the second derivative plays like the power producers. But yet those companies that we think are the early adopters of AI in their own businesses and their products actually held up pretty well. So we looked at, the Microsoft, the Alphabets, Meta, ServiceNow, Salesforce, Adobe, all those companies, held up very well. Some of the sectors that we thought will be big beneficiaries of AI, like cybersecurity, also did very well as well. So I think, this is the year really looking for more of those, idiosyncratic companies that are able to leverage AI into their own businesses. And that's where we're going to be looking more for upside surprises in earnings.
Now, we've got more detail too this week, Dave, with earnings results from the likes of Alphabet, Apple, and Microsoft. What were your takeouts?
Well, the one that was actually most interesting to me is going to be Alphabet. So we currently rate that stock as 4 stars. It trades at a 19% discount to our fair value. Now, the stock initially fell over 7% after their earnings came out. The market was just generally disappointed by a combination of the deceleration in their cloud revenue, but yet an acceleration in their CapEx. So I think the market is looking for, operating margins to contract. We think the market really is overreacting to this short-term nature. In fact, our analyst team raised our fair value by 8% to $237 a share. We expect that, Google will probably be able to, reaccelerate in the second half of the year. Now, I would note too, similar to Microsoft, both of these companies have been capacity constrained in their cloud for probably the past 6 to 12 months. They've both been spending a lot of money in CapEx in order to be able to expand that capacity. And we think that in the second half of 2025, both of these companies will start seeing some additional revenue growth there. So I think once the market sees that, it really approaches that in their valuations, we'll see both of those companies bounce back.
So overall, Dave, how are you seeing valuations on the market at the moment, particularly if we break that down sector by sector, and where are you seeing the value?
Yeah. But overall, the U.S. market is still a little overextended in our view. It trades at a 3% premium. Now, personally, I would still remain market weight here. It's not enough of a premium that I'd look to underweight. And in fact, if I look at where the market has been really since earnings have started this year, it's been pretty range bound. But what I'm seeing, underneath, the top line is looking and seeing, a big rotation. Well, not necessarily big yet, but we expect it to be much bigger. But we are seeing, that rotation into value stocks, out of growth stocks. We're also seeing, the rotation down into small cap stocks and away from the large cap stocks. So those are the areas that we see, the best value for investors today. Small cap stocks still on both an absolute value basis and relative basis, trading very undervalued, traded at 11% discount to fair value. Large cap stocks at a 4% premium by capitalization. Taking a look at stocks there, again, we still like the small caps versus the large caps.
And underweight growth then.
Exactly. In fact, growth is trading at about a 14% premium to our fair values, at this point in time. Last time we saw growth really trading at that much of a premium or more is back, if you remember, like 2020, early 2021, the disruptive technology bubble. At that point in time, growth was trading at an even higher premium than now. But of course, we do think it's probably run its course and looking for that market to move, more into that value category. Typically, I would expect value to do better once the economy starts to slow. That is the view of our U.S. economics team, for the economy to slow here in the first quarter and the second quarter. Not enough to get into a recession, but enough that we would look for earnings slowdown to hit the growth stocks a little bit more than the value stocks in the short term.
And Dave, just briefly, look at energy. Has come under pressure, particularly oil, which is obviously beneficial as far as Donald Trump. That's what he's been calling for. But when you take into account his policies, obviously encouraging greater production, how are you seeing the energy sector?
Well, overall, we think the energy sector is one of the more attractive ones today. As you noted, a lot of negative market sentiment, and I think that's what's driving some of the attractive valuations in our mind. Overall, the energy sector trades at a 10% discount to fair value. And one of the things I like about energy is we actually have a bit of a bearish outlook for energy over the long term. So our forecast for WTI, or West Texas Intermediate, over the long term is $55 a barrel. For Brent, it's $60 a barrel. But even when you include those in our longer term forecast in our model, a lot of these companies still look pretty attractive to us. So the stock I'd probably highlight right now is going to be Exxon. That's typically our pick among the global majors. It's a 4-star rated stock, trades at a 20% discount, has a pretty attractive dividend yield too at 3.6%.
Dave, thanks so much for giving us a view of your strategy there at Morningstar.
Thank you.
Dave Sekera, Chief US Strategist at Morningstar. Let's take a look at where we're likely to get going. So SPY futures off around 0.1%. That, of course, comes off the back of yesterday's impressive gains. And we're going to get right across the open in just a couple of minutes' time.